Welcome, everybody. It's wonderful to be here and have you join us for the second webinar in our Lunch and Learn series. Today, we're talking about Web3 for business, during which our presenter will cover three key aspects of the Web3 environment: blockchain, digital assets, and the metaverse. Before I start, I'd like to acknowledge the traditional custodians of the various lands on which we're all located today, and pay my respects to elders past and present and emerging, and extend that respect to all Aboriginal and Torres Strait Islander peoples. Hi, I'm Dr. Craig Cameron, a Senior Lecturer in Corporations Law here at the Griffith Business School. I'm also a Griffith alumnus, having completed my Bachelor of Laws and Bachelor of Business here, and returned to complete my PhD in 2017. Before I introduce our guest speaker today, a brief message from Griffith alumni. Did you know that in addition to the Lunch and Learn series, Griffith Alumni offers the peer-to-peer mentoring program, a fantastic way to connect with other alumni around the world to share your skills and learn from one another. The program is exclusive to Griffith alumni and entirely online, so you can connect wherever you are in the world. Whether you're early in your career, considering a change, or have decades of experience, you can search for a match to provide and receive advice, engage in discussion topics with other mentors as well. All the details about the program are available right over here in the chat section of this Teams Live site. Now, speaking of Teams Live, there are a few admin things to tell you about the platform to help you make the most of it today. Number one, you can ask questions in the Q&A panel on your screen throughout the presentation. Now, it's my job to put them to Josh at the end. If you'd like to remain anonymous, no problem when asking your question. Please tick the anonymous box before posting. The session is also being recorded and will be shared on the Alumni YouTube channel. We'll email you when it's available, and you can also subscribe to the channel to see our other webinars on offer. Now, let me introduce you to Mr. Josh Murchie. Josh completed a Bachelor of International Business and a Bachelor of Commerce in 2015 and returned to start a Master's in Information Technology. On a volunteering trip to Peru in 2017, he had a realization. He wanted to do more and could use his skills for global social impact. A short time after the trip, Josh, a former student of mine, pitched to me an idea. He explained how he wanted to improve transparency and trust, as well as reduce costs associated with donations in the charity sector using blockchain technology. In my very supportive, teacherly tone, I replied, "That's fantastic, Josh. Just one question. What's blockchain?" At that point in time, it was a kind of a sliding doors moment. The teacher became the student, and I've been that student ever since. Josh went on to create Little Phil to influence micro-philanthropy and connect donors with the people and programs they really want to support. He is a co-founder of Little Phil and the social impact group, Xillion.one, a Yunus Centre fellow and digital innovation expert. As a social entrepreneur in residence at the Griffith University Yunus Centre for Social Impact, Josh works with students, staff, alumni and peers to nurture and inspire the next generation of social entrepreneurs. Now, joining us all the way from Paraguay today, I now hand over to Josh. And just note, Josh, you'll need to flick your microphone on. Thanks, Josh.
Thanks, Craig. You guys can hear me? Yep, awesome. Thanks so much, Craig. It's a pleasure to be here, and thank you for Bridget and the alumni team for organising this and everybody for attending. Just bring up my slides, 1 second. Okay. So thanks again. Thanks for having me. As Craig mentioned, sorry, this is a bit slow. As Craig mentioned, my name's Josh. I'm the co-founder and CEO of Social Impact Group, and Little Phil. So we've been working in this space, the Web3, blockchain, cryptocurrency space, specifically more around impact for about 5+ years now. And hopefully today I can give everybody a little bit more of a layman's term overview of what is Web.3, what is blockchain, the technology, and some use cases in real life. So if we have a look at the transition from internet back in the 90s, where we really started to be consumers of content. So there were, large companies and organizations which would be publishing different kinds of content, and we would just consume that content. That started to move more into what's referred to as Web 2.0, where we're also contributing. So Facebook and the likes, where we're contributing content. We're writing blog posts, we're uploading videos, we're really a part of this whole technology platform. Web 3.0 is where we are heading at the moment, and it's more around decentralization and ownership. What does that mean? That basically means that the current system where you've got in the Web 2.0 system, all of these big tech behemoths who own and control, most of the data and the intellectual property and so on around the company, is moving to more of a decentralized model where, as a user, you would own your own data. For instance, how is it being enabled? It's really blockchain. It's an important piece to note as well that blockchain and Bitcoin are not the same thing. So Bitcoin was really the first large-scale product to be built out on blockchain, and is a blockchain. And as an example of how blockchain works, say for instance, I own 1 Bitcoin and I want to send that Bitcoin to Craig. I can send that across the network, and then there is a network of what's referred to as miners who will process and confirm that transaction. Once it's confirmed, it'll be put into a block of lots of different transactions and then added to a chain with all the different blocks of past transactions, hence the word blockchain. So it's an immutable distributed ledger, which means that you cannot change, edit, or alter anything from the past. It's there forever. The next kind of phase from just being blockchain and bringing in that trust through distributed ledgers was around smart contracts. So Ethereum is probably the first platform that was developed to blockchain, which allowed for smart contracts. Why is that important? So currently, with so many different intermediaries and middlemen, providing that service of trust, whether that's accountants or brokers and the like, all taking a clip along the way. After smart contracts come out, and this is kind of where we are and where we're heading at the moment, is we're removing that intermediary and that intermediary risk. So traditional contracts, we've got 2 or more parties who enter into a contract or an agreement. We have somebody sitting in the middle who's usually the intermediary who will provide that trust or level of comfort for the parties. Slow, costly, and it also has an inherent intermediary risk, as in, say if we've got funds held in trust by that third party, do we actually know that they've still got them? When it comes to smart contracts, 2 parties can enter agreement with a smart contract, which lives on a blockchain. And once those conditions are met, the funds that are held in escrow within that smart contract can be released to the other party. So we know that the funds are there, they're locked, they're in a smart contract which can't be changed or edited. So we're decreasing the costs, the risks, and making things faster and cheaper. If we look at token types, So there's two main technical types of tokens, which is fungible tokens and non-fungible tokens. And then the list goes down around what utility these tokens have, whether they're a pure utility token, whether they're a cryptocurrency such as Bitcoin, whether they're a governance token, a security token, so on. So what is the difference? Bitcoin, for instance, is a fungible token. So me, as an owner of Bitcoin, I could send Craig 1 Bitcoin, I could send Bridget 1.3 Bitcoins. It doesn't matter, they're not unique. It's just a number in a ledger. So you can break it up and it's not unique. A non-fungible token, so as the word infers, it can't be broken up. So think of that like a certificate of authenticity. I couldn't go tearing up a certificate of authenticity and giving a little bit to Bridget, a little bit to Dave, a little bit to Bob. What are some of the benefits of decentralization and why is Web3 a good thing? So you may have heard the quote that, you know, if you are not paying for the product, then you are the product. So if you look at the Facebook example, Facebook basically consumes huge amounts of data. So they know you inside and out if you're a user. They then bundle that up and they sell that to advertisers. They don't share any of that revenue with you. They don't tell you who they're selling that data to. They don't really give you any control or privacy or ownership over that data. All you're getting is just access to the platform. In Web 3.0, it's more around you having control of your own data and your own assets, whether that's, you know, the different likes, page likes that you have, whether that's your medical records or your financial details. All of this for Web3 would put the power back into the user's hands. DeFi, which is really deserves its own topic in itself, so decentralized finance. Bitcoin could be considered probably one of the first in this space, as in a non-centralized authority has issued a financial product or service. So Bitcoin being a digital asset, probably most commonly referred to as digital gold. Nobody owns or controls that, as in the network. Nobody can force the network to print more. The rules are set in code. And there's a relationship between the people that own Bitcoin when they're sending the Bitcoin and the contracts and so on. So DeFi can actually and is already disrupting banking, finance, borrowing and lending, all of these different markets, and will continue to do so. A good little snippet there of the Bank of Cyprus from back in 2013 when they were forced, the Cyprus government was forced to enact the bank bail-in laws, which basically meant that if you had savings in the Bank of Cyprus, the bank could put their hand into your savings to bail themselves out, and they did. Metaverse. So there's a huge amount of hype around the metaverse at the moment. My personal opinion is that it's still very early, and it's still probably going to be about 3 to 5 years before we start to see anything huge mainstream adoption. However, it's already starting. So as you can see in the example here, Snoop Dogg is running concerts in the metaverse. So it can be the future of, you know, entertainment. It can be the future of e-commerce, healthcare, marketing channels, and more. And I'll touch on that a little bit later in the slides. And then infrastructure. So if I told you that you could own a piece of the Royal Australian Mint that is, or the infrastructure that's minting the Australian dollar, and you'll be rewarded in the dollar, it sounds pretty good. So this is the whole concept around decentralized. Not one central authority is doing it. There's people all around the world who are connecting up to secure these networks and actually help create this Web3 ecosystem. So some business model examples. One that I personally like is Crypto.com's staking for benefits. So staking is kind of like putting a deposit down. So for example, in this slide, you can see that if you want to get access to one of the Crypto.com credit cards, you need to purchase X dollar amount of their native cryptocurrency token, so CRO, which is a utility token. You then lock that up for 6 months, kind of like a term deposit. Then they'll give you access to different benefits and features depending on how much you've actually locked up of their token. Why is this good? So one, we're starting to get to the stage where the more people that wanted to buy this token and lock it up and then use the platform, the faster that this business will grow, the more likely that, you know, that token price may appreciate, and they're rewarding you in their own tokens as well whenever you're spending. So different loyalty incentives, different growth mechanisms around marketing. And I recently caught up a few days ago with the general manager of Crypto.com, who told me they got 50 million users. So it seems they're doing something right. An example of going from a traditional world to a digital world with NFTs would be NBA Top Shots. So moving traditional sports trading cards, as in cardboard trading cards, into the digital world and using NFTs. That means that instead of you buying a packet of cards from the news agency and, you know, you've got a picture of one of the players about to take a shot, these are actually digital video snippets of, you know, the player just about to take the shot and win the grand final. And maybe it's a 1 of 10 rare, super rare clip, original. And because it's an NFT and because it's on blockchain, it's provably rare, it's provably original, and you've got no risk of it ever deteriorating. And arguably, it's better for the environment. Using NFTs for access and loyalty. So there's quite a few large brands that are getting in on this now. In this example, we've got Dolce & Gabbana, who recently had a fashion show in the Metaverse. They sold a physical dress which came with a digital representation or a digital asset as an NFT. With that NFT, if you're holding it, it would provide you access for 2 years to their exclusive fashion shows in Italy. So they're starting to promote, you know, customer loyalty. They're highly likely that whichever customer has that NFT is going to go to those exclusive shows. They're probably going to go and buy more. The next time they try and do a drop like this or a sale like this, the interest should be higher and they'll probably fetch higher prices. Or if I purchase that item and I receive the NFT, I could sell that NFT to somebody else and they could have access instead of me. Nike is in on it as well. So Nike's bridging the gap between physical and digital, basically have a Metaverse style gaming collaboration with Roblox, where I could be, connecting up my physical world results. So say I run a 100-meter sprint, and I could be competing against other people anywhere in the world. I could then be decking out my digital avatar with all different Nike gear. You know, Nike could be testing out new styles of products digitally on their avatars to see how many people are fitting them out with that before they end up producing it. So it opens up a vast array of different avenues that brands can work with. DAOs, so decentralized autonomous organizations. If you think of it kind of like a company with shares, although you don't have to go through all the regulatory frameworks to do that, this example is a group of people come together. They set up a DAO as a smart contract. They all contributed funds into this DAO, so $4 million US. The DAO then purchased and is the custodian of this limited edition Wu-Tang album. Everybody that contributed to the DAO would receive a DAO governance token, which that they have some kind of small ownership over this asset, and they have a say over what it should be used for. So if we have a look at already some of these technologies and how they're being combined, if you remember how a non-fungible token is designed so that you can't break it up. So it has to be, I can send one to Craig or one to Bridget, but I can't give half and half. Excuse me. We have projects like Xillion who are working on technology that will allow users to fractionalize NFTs. So using smart contracts and DAOs, where a DAO can own one or many NFTs, it can then break them up to fractional fungible tokens, and then 1 million people could own a small piece of one NFT. So projects are starting to combine these different kinds of technologies so that to make new and innovative platforms and so on. A case study and how we can put this all together. So giving an example of Little Phil, which is our Little Phil micro philanthropy platform that we've been working on, we're applying these different styles of technologies with traditional Web 2 style technology as well to fix the charity industry. So increasing trust, increasing transparency and sustainability for charities, causes and beneficiaries. What does that mean? That means that not only are we building platforms to allow charities and causes to raise donations once off or monthly with debit cards and credit cards and so on, we're also allowing them to do things like have a company empower all of its employees or customers with giving credits. So now they can make a decision on wherever their company that they work for or the company that they purchase from is making an impact. We're working with different cryptocurrency projects and metaverse projects. So another example would be an NFT game where every single item that they sell is an NFT, and a percentage of that item comes back to funding charities and causes through Little Phil. We also have the technology to launch DAOs, decentralized autonomous organizations, as a campaign or a charity. So that means that, say, me, Craig, and 50 other people in the local Southport area all want to come together and contribute some cash to help the homeless problem in the area. We could do that and then receive the governance token, and all of us could put a proposal to the DAO as in, okay, I want to go and fund out of our proceeds we've all put together, I want to go and fund 5 beds in this establishment for a year, and it's going to cost 50 grand. Okay, great. If we all vote on that and say yes, we can release the funds from the DAO. So working on ways that we can change and make this whole industry better and more transparent. Our next step for Little Phil is working around the post-donation. So around DeFi, decentralized finance. So across the world, there's over 2 billion unbanked people. One problem that we've identified whilst working in this industry is that the world seems to gravitate to donating towards the current issue. For example, Ukraine right now, the world has been donating huge amounts of money to Ukraine, but what happens in 3 months or 6 months or a year when the world's on to the next current cause? So they're not donating to Ukraine anymore. There's still going to be hundreds of thousands or millions of people who need access to finance to rebuild their lives. We don't know if they've got access to banking anymore after this. We don't know if they've got ID even. So how do we use these technologies to be able to create Web3 digital identities, Web3 credit scores, allow local organizations and partners on the ground to be able to recommend to a DAO beneficiaries that should get a loan. So say Bob is a builder and he needs a couple $100 to go buy some more tools to restart his building business. He can apply to a verified field partner on the ground who then says, okay, yep, I know that Bob's a builder and I'd like to recommend him for that $200 loan. When Bob pays it back, it's going to increase his score and it's going to increase the local field partner's score as well. So effectively increasing their amount of, or their reputation when it comes to borrowing and when it comes to recommending and so on. So we're really focusing on that leg up and not a handout. And if you take a step back, you'll be able to see that we're putting this all together, these different technologies. So DAOs, we're putting together unique digital identities, we're putting together access to DeFi, microloans, and so on. Where to start? So we will be, with some partners, we'll be launching web3.org.au. So I'd recommend subscribing there. That's going to be a place where we're putting up content from not only founders and experts in Australia, but across the globe as well. I would then say just start by buying a little bit of crypto. So register on an exchange, crypto.com, SwiftX, one of those local kind of Australian exchanges, purchase $20, $50 worth of crypto, and then set up a Web3 wallet. So MetaMask, for instance. Try to send crypto from that wallet to a decentralized Web3 wallet. Attending meetups. So there's a great blockchain meetup on the coast run by Darren, and I can give a link to anyone that's interested. Partnering with Web3 companies. So if you are working in a company or you own a company at the moment, you're interested in this space, I'd highly recommend reaching out and trying to work with, partner with, advise, give pro bono work, whatever it may be, to different Web3 startups, because you're going to learn exponentially. There will be a transfer of knowledge. Opportunities. So with this whole crypto space, access to new markets and customers. If you look at the crypto.com example, that company's, what, 4 or 5 years old, they've got 50 million users. That's more than, what, double the population of Australia. So you can be going global from day one. You can reduce your marketing costs. So using utility tokens to help drive organic growth and marketing and campaigns around referrals and rewarding customers for loyalty and so on. Digital assets like NFTs and the likes to reward a customer is better for the environment also than what physical merchandise is. So the media like to bash NFTs, but they just don't understand the technology properly. And you're also future-proofing your team and organization. So this space is not going anywhere. It's just going to become deeper and deeper ingrained. And whether or not you understand it or whether or not you're just a user, it won't matter. The benefits for your team will be immense. Hazards, I'd say that one problem that I see often is that people think that they know exactly what they're doing. And, you know, unfortunately, that's just not the case. So just assuming that you know and not working with experienced people or listening to younger employees as well. Untrained staff. So that can be a problem. Say you have a strategy in this space and either you've got a key man within the company or you're hiring consultants and you fail to educate your staff as well. That can actually pose quite a significant risk if it's not executed properly. Don't bet the farm. So it is still emerging tech. It's evolving every day. You know, it's something that you should be investing in, but it doesn't mean that you should be betting the whole business on it. And the biggest hazard that I see is user error. So with DeFi, or say with Bitcoin, for instance, if I went to send 1 Bitcoin to Craig and I accidentally put the wrong address in, there's no way I'm getting that back. It's gone. So it's usually user error that we see, and that's probably the other biggest hazard. Thank you again for attending, and thank you so much for hosting me, Craig, Bridget, and the team. We've also put on, the guys at Little Phil, we've also put in $25 in Little Phil giving credits for anyone that wants to find something they care about and donate to. No credit card needed. Just scan the QR code there and give away. Thanks again.
Thanks, Josh. You ran like the Swiss there, bang on time. Thank you very much. We've got plenty of time now to go through a number of questions. Just a note, if we don't get through all of these questions by the 1 p.m. deadline, no worries at all. We will record a separate session covering the Q&A, which we'll make available on the Griffith Alumni site. A number of questions came in around, will the PowerPoint slides be available? They're a little bit blurry, can't see them. Great graphics, Josh, but I'd like a copy. No worries at all. Once again, the Griffith Alumni team will push those out to all attendees. So, Josh, I'm just going to move past the very technical questions here, and I'll go to Sally first at 12 p.m. And the question is, who owns the blocks and the platforms? How are they kept secure?
Good question. It's different depending on which blockchain. So let's take Bitcoin, for instance. Bitcoin runs on what's called a proof of work algorithm. So it requires physical computers to be all connected and processing these transactions. And if there's more of them and more computing power, the blockchain is more secure. If someone could control 51% of that computing power, then you would have an issue around potentially having someone attack it and take it down. But to do that, the financial costs now, say for Bitcoin, would just be immense, and it's kind of at that stage where you would say it's too big to fail. So nobody essentially owns it, it's distributed.
Thanks, Josh. The second question, and this is on the lips of a number of Web3 proponents, and it's from Anonymous. Anonymous writes, a lot of Web3 seems far from decentralized and is controlled by a few interested parties. How can we break that control? And if we can do that, do you expect people to run their own servers?
I'm not sure what they mean by run their own servers, but it depends. That's another depends question on what style of consensus mechanism and how things are structured. So for instance, with a decentralized autonomous organization, there's different voting mechanisms that you could put in place. So I could say that every wallet address, every person, regardless of how many tokens, so regardless of their financial means, will only have one vote. So it doesn't matter whether you're super rich or super poor, it doesn't matter. You'll all have one vote. I could be coming in and saying that there's a length of time that you need to hold these tokens for. So there's a lot of different mechanisms that you can put in place to help create a more equal and decentralized ecosystem for Web3. But you're definitely right, there's a lot of larger investors and VCs who will come out and want to try and play the game for themselves.
Thanks, Josh. The next question from Vic, and looking at price volatility of tokens, Josh, question is this: given the volatility in Ethereum, Bitcoin, and crypto generally, how do decentralized contracts on blockchain gain more trust?
I don't see it. It depends how you're viewing the token. So I don't view Bitcoin as the same as I'd view a dollar, for instance. Bitcoin I view as an alternative to something like gold. where it may fluctuate in price. And if you look at the price of gold, it fluctuates. Ethereum, I view it as in the more usage of Ethereum over time, then it should, I would assume it would be going up, or less usage down. So it depends how you view it, but there's stable coins and not, I know that it's probably going to go to a recent question around Terra, but there's stable coins that have been around for years who are not considered experimental. And say, for instance, personally, I hold stable coins and I am perfectly happy and fine with that. And I earn a lot more interest on that than I do in a bank. And then I have that connected up with a Visa card, which I can spend wherever I want. So the volatility I don't see as an issue. It's really a personal strategy around how you handle that volatility and your risk appetite.
Josh, the next question is around the impact of tokens, and I assume this is directed at Bitcoin on the environment. It's from Shelley. Shelley asks, better for the environment. That might have been a comment during your presentation there, but her question is, any comments on data center energy demand?
I'll assume that she's talking about mining. So with Bitcoin mining, yes, and Ethereum mining currently, there's definitely an issue with how it's conducted. So there are a lot of mining outlets using what's called the proof of work algorithm. So it uses hardware to do that. And they will just go for the cheapest energy source, obviously, because the cheaper the power, the cheaper it is for them to mine and profit. That is starting to move. So for instance, we have a project that we're working on with some partners around green Bitcoin mining, which is using 100% hydropower. The engineers have designed systems to cool the systems and reduce the noise pollution and reduce the actual footprint of the operation itself as well. So there's a big push both from governments and both from industry that they want to make this greener. It can also help the local communities by offsetting power costs as well. I'm not sure if we may have lost Craig.
That's okay. No, I just took the screen off to conserve power. Given the question asked, I thought I'd be environmentally friendly. But the questions keep coming in thick and fast, Josh. I started with 11, now we're at 34. So let's see how we go in the 22 minutes we've got remaining. Mark's asked a couple of good questions around property. Sorry, mate.
I'll just add one more thing on that environment. See, so if it was in reference to NFTs, so creating digital assets as NFTs, you can actually do that on what they call a layer 2 blockchain, which still sits on top of Ethereum, but it uses about 1/1000th of the energy. And it also, so say for instance, Polygon, they've also hit carbon neutral or negative. So it's a lot of the times it's the media not understanding the technology and not understanding how people can use it. So yeah, hope that helps.
So Josh, just to clarify there, just around education on the blockchain platforms, the layer 1 is Ethereum, is that right? And layer 2 are now alternative blockchain platforms like a Polygon.
Yes, so layer 1, like Ethereum, is, think of that like the primary settlements layer. So if you want to interact with that, it's only got so much space. So kind of like a flight, and it's a really busy time. And if you want to get on that flight, you're gonna have to pay more, and it's expensive, and yada yada. So there's only so much space. But what a layer 2 does is basically turns one seat on that plane into 1,000 seats. So now using that layer 2, it still uses Ethereum, but it only uses 1/1000th of the actual power and energy and cost to do it.
Thanks, Josh. Next question from Mark, and I know Mark's got a couple of questions. Good afternoon, Mark. His question is, first, the where and how this will impact property and property transactions. So how will Web3, I'm assuming, will impact property and property transactions? Josh?
I think it will impact it in a bunch of different ways. So if you imagine the whole process of buying a house, you've usually got to go get a loan or a pre-approved loan. So right now, the people that fund those loans are usually banks and so on. Imagine if everybody, it didn't matter who you were, could all chuck in a certain amount that goes into just financing homes. So a DAO or a DeFi DAO could do that, and you could put together $1 billion fund, and the whole goal of that fund is to give out home loans, and you set criteria around the applications of credit and what's approved and what's disapproved, and all of a sudden you don't have the bank or the mortgage broker needed to do it. It's all just handled by smart contract and conditions in code. It could be fractionalized ownership over the homes. So the home could be converted into an asset, which is then, say, an NFT, and then fractionalized. So fractionalized ownership, funding, almost anywhere where there's an intermediary, you would be able to remove them.
And Mark's got a further follow-up question. I'll ask that first. Wilson, I haven't forgotten about you. I know you've got a couple of questions there. The question is, what about cross-security lending? Microloans don't mean anything in the environment we operate.
Cross-security lending.
We might take that. Yeah, we might take that offline, because I probably need a little bit more context, Mark, around the environment that you operate in, and certainly post a question with a bit more detail there, Mark, and I'm sure we can answer that in our next Q&A session. Wilson, your question, it's around the NBA Top Shot. And Wilson's question is, what if I create the video shot and make a copy before I sell via NFT? Wouldn't I be able to sell millions of copies of the shot, and rather than only one copy from the NFT?
I guess the same question comes to any kind of IP. So just because you can draw a really nice Nike logo doesn't mean you can put it on different pieces of clothing and sell it. Yeah, that's the best way. I think a lot of people get confused with, oh, this is just a JPEG, or this is just a, .move file or whatever it is. But really it comes down to, is the IP attached? If the IP is attached, great. If the IP is not attached, then I would agree, what's the point? But yeah, hopefully that answers the question. If you're doing that, then the value of the NFT would be worthless anyway. So then you kind of just be scamming people.
And that touches on the legal area there, Josh, too. It's about the legal rights attached to the NFT as well. And they can be prescribed around licensing, for example. I'm losing the battle with the Q&A, and now up to 38. I thought I'd really got into the questions, but I'll just be mindful for those in the audience, if they're what I would consider technical questions, i.e. questions that I don't understand, we might cover them in a separate Q&A. That may be more beneficial, because then you'll get a full explanation from Josh as to those overly tech questions. So the next question comes from Cecile. What is the security level or tracking system applied to the donation to ensure it goes to the right person or social organisation that supports the cause the person has donated for? How do we verify identity through Web3 tools? Josh?
Yeah, that is a really challenging problem. So imagine you've got refugees who have zero ID. It's a challenge that nobody's got right yet. Our approach is more to work with those verified field partners, and you have to be building up that ID over time. So you would have, say, a charity that we work with, Xillion.one. They do on the ground charity work with refugees in the Middle East. We would require them to basically upload a beneficiary and their details, and then we'd have a credit scoring system around that, as in, okay, this is John, and John has 3 kids, yada yada. John's sister knows that that's John as well, and she's verified it. But really, in those cases, it's very difficult to do, and you have to be building up an ID from scratch as if you're almost a newborn. The main thing is around how do we build up their Web3 ID and credit scores around if they take out a small loan and they pay that back, and they take out another small loan, they pay that back, and maybe they recommend someone else and they do the same. We're starting to build up this trust score on how well we should trust them. But outside of that, I mean, it's a challenge that I don't think any organization has figured out the best solution to yet.
Thanks, Josh. I've just got a couple of questions on, it's on your opinion around the recent crypto crash. And really my concern, and I'm not your lawyer, but I'll provide legal advice, is that you're probably providing financial advice in breach of the Corporations Act, even though that your domicile at the moment is Paraguay. I just don't want you to get into trouble, my friend. So if you would like some non-financial advice in a social setting, such as what is your opinion on the recent crypto crash and will it recover quickly, or Victor Wong, one of our prominent academics here at Griffith, so what crypto should I buy to get a Lamborghini? They're things that could be covered perhaps socially with Josh, and we'll provide all Josh's contacts. He's got about 5 different channels, some of them I haven't heard of before today, available in possibly the chat, or they'll be sent out through the Griffith alumni. So if you'd like some off the cuff non-financial advice, we might cover it on another channel. Okay, let's keep going through these questions. Quinton, can you please speak to the volatility of Web3, recent fall in the value of blockchain currency? Thank you.
I mean, I'm going to assume that a lot of these questions are coming from people that are relatively new to the space. But if you go back and look at the charts over the years, this always happens, and it's happening with the stock market. So right now you go through bull and bear cycles. Crypto, the last, what's referred to as a crypto winter, was back in 2018. And that went on for a little while, but what we're seeing is back in 2018, we had Jamie Dimon, the JP Morgan CEO, coming out and saying he's going to fire any of his traders for touching Bitcoin, and, you know, it's the devil, blah, blah, blah. Whereas today they've just published something saying that they believe Bitcoin's 28% undervalued and it's their preferred alternative asset class. So I think that we won't see, my personal opinion, not financial advice, I think that it won't be as long as what it was in 2018, so that kind of down period. I think that it was probably a little bit too hot with Metaverse stuff and people just not fully understanding it. Do I think that Metaverse will be around in 3 or 5 years? Do I think that there will be companies that will come through and projects come through and be the leaders that are here today? Definitely. We see it with projects that got through 2017, 2018, who had tokens and they came out and they're 100x or more. So it's just it's a cycle, and it happens, and then there'll be another kind of bullish cycle, in my opinion.
Thanks, Josh. We are running out of time, but we are getting through these questions. Probably 2 to 3 more, and I can actually answer the next one too, briefly. Question, Josh. Can Josh explain a bit more about the purpose of tokens? I didn't quite understand how they work with the blockchain. Thanks, Anonymous.
Yeah, sure. So there are many different types of tokens. Like, I could probably send you a graph with about 50 or 100 different types of tokens, as in what they're used for. The most common that you see are referred to as utility tokens. So an example would be something like, I don't know, you need to buy phone credits from Skype and it's 1 credit per minute. You could buy these tokens and use them and get a discount on the cost of it. The crypto.com token that I showed in the example is a token where you use that and you lock it up, because a token project, what they want is they don't want people just selling their token all the time and trading their token. So it's better for them to have you lock it up and become a kind of loyal customer or supporter of them. So you've got those kind of tokens, which are utility, and it's usually used in a platform. So it's, you know, you get access to benefits or features, or you get access to discounts and so on. Or you've got those governance style tokens, which are like for the DAO. So maybe it's voting and you get to vote on certain things, and you might be rewarded for voting on certain things. And then you've got security tokens, which are coming out at the moment, which, as they say, it's a security, so it needs to be registered and regulated like a security. And non-fungible tokens. So if you think of anything in the real world where, excuse me, it needs to be unique, that could be replicated using non-fungible tokens. So something unique that you can't break up and give to someone else, you know, that could be replicated by a non-fungible token, if that makes sense.
Thanks, Josh. Just 2 questions to go, and I'll just jump in and answer Kerry's one for the sake of time. Who can start a DAO and how? The answer to that question, Kerry, is that the Australian government is looking at giving DAO a recognised legal structure. So there's a recommendation made by the Bragg report, and I can send you a copy of the link that Australian government will assess the applicability of recognising a DAO like a company or a trust or an association. At the moment, you can start a DAO today. We could do it straight after the session if you like, but it uses traditional legal structures to give the rights and obligations attached to the DAO. So if the DAO's for profit, it's likely to be a partnership. Likely, this is not legal advice and shouldn't be treated as such. If it's not for profit, likely to be considered an unincorporated association. And the risk there for a not-for-profit is that the members have unlimited liability. Same with a for-profit partnership. The partners have unlimited liability. So that's the risk of operating a DAO now. Okay, last question, Josh. So many questions. And remember, we will make a Q&A available to cover off all of your questions after this session. The question is, what are the most purposeful ways to leverage a business's own tokens into their smart contracts? For example, pay-per-call, subscription contracts, staking, etc.
I'm not sure I understand the question properly. So what is the best way? You're a business and you've got your own token, and what's the best way to implement them in your own business?
Yep.
I think that depends completely on your business. So do they give any context of what business it is?
Sorry, mate, I just lost you there. I got a little bit of cut out.
I just said, was there any context of what business it is?
No.
If I understand what business it is, then I might be able to give you some examples of how that may work. But usually you would use a token for rewards, loyalty, discounts, access. You could be using a token to give for referrals, or they could be redeemed for products or services. There's a vast array. And then if it's, say, an NFT, it could be used for, again, for like VIP access. So for instance, with the Xillion project, there's a VIP NFT, which means that if you hold that NFT, you'll get access to a secret group. So this is where, you know, early news and these kind of insider early access things come to VIP people, and the technology automatically checks whether or not you're holding that VIP NFT. And say, for instance, that you give it to someone else or you sell it, it'll kick you out of the group automatically. So yeah, there's a vast array of different avenues that you can use to implement a token, and it's commonly referred to as tokenomics.
Thanks, Josh. And please keep the questions coming. We can't answer them. I'll just put my video on. We can't answer them all in the last 5 minutes, unfortunately. We do want to provide value for money, and we will do it in a separate Q&A session. So feel free to continue to post questions in the live Q&A. As Josh mentioned, if you can provide some context, maybe it could be a sector or it could be a business idea. I'm sure Josh would be more than happy to answer those context-specific questions as well. All right, so look, Josh, fantastic session. Really thank you for your time today. We've covered a lot of territory in such a short space of time. We've had over 1,000 alumni register for this session today, so there is a clear appetite for Web3, and of course we have questions coming in even now for further consideration. So I'm hoping that everyone's taken away an idea, perhaps consider for your business, whether you're an owner, employee or a service provider to a business. For me, the key takeaway from a kind of a governance perspective, if you're in management or you're a director of an entity, is that you need, as part of good corporate governance, consider Web3 as an emerging risk. And risk is kind of twofold. It's the opportunities associated with Web3 and maximising those, but also minimising the potential hazards that Josh has identified in the Web3 space. So thank you, Josh. That was my key takeaway for today. Just a couple of admin matters before we round things up today. The alumni team will send a follow-up email in a few weeks with the recording, so you can watch over and over and over again, share with your friends and catch anything you missed. The next webinar in the series will be in August. I don't know what it's going to be, but it's going to be brand new and fantastic, I'm sure. So please keep your eyes peeled for an invitation. Note that last month's webinar on managing change in times of uncertainty with Jody Keys is already available on our YouTube channel. If you subscribe to the channel, Griffith Alumni, you're not going to miss out. Just do a search, Griffith University Alumni and Giving, and there's also a link on the alumni website. So again, thank you so much, Josh, for sharing your time and expertise with us. And thank you to everyone attending online. And on behalf of the Griffith Alumni team, it's a very good morning, good afternoon, and good evening to you all. Bye for now.